that feeling of pure invincibility, when the stock you own rockets to a new all-time high, and every news headline confirms your genius. The world seems to slow down, and for a moment you believe you've finally solved the puzzle of the market. Then, in the span of just a few hours, that perfect green candle on your screen begins to shrink. The strength evaporates. By the close of the day, not only has all the gain vanished, but you are now staring at a loss, and a cold, heavy feeling begins to settle in your stomach. The market has just sent you a message, written in the universal language of price and volume, and it is one of the most urgent warnings a trader can ever receive. This experience, this sudden and brutal reversal of fortune, is not a random act of market chaos. It is a specific, observable phenomenon, a pattern of behavior that has repeated for over a century. It's what the great speculator Jesse Livermore identified as a one-day reversal. This is not merely a dip in an uptrend. It is often the first loud crack in the foundation of a bull market for a particular stock. It signifies a profound shift in control, a moment where the overwhelming force of demand is suddenly and decisively met and conquered by an even greater force of supply. Understanding this signal is not just about making money. It is about protecting the capital you have worked so hard to accumulate, because the market, in its own impersonal way, always warns before it strikes. The question is whether we are listening. Let's delve into the psychology of the uninformed participant during this critical moment. The novice trader sees a stock that has been rising for weeks, even months. Every small dip was bought, every analyst is positive, and the story behind the company seems flawless. When the price breaks out to a new high on this particular day, it triggers a powerful emotional response known as the fear of missing out. They see the price moving without them and feel an intense pressure to get in before it's too late. They buy, often at or near the very peak of the day's excitement, feeling a rush of relief that they are finally on board the speeding train. As the price begins to pull back later in the day, their initial reaction is not fear, but justification. It's just some profit-taking, they tell themselves. A healthy pullback after a strong move. Even when the price closes down for the day, having completely erased the morning's gains, they cling to the bullish narrative. They look at the company's story, not the market's action. They are holding a belief, not trading a reality. The one-day reversal is invisible to them because they are looking through a filter of hope and prior commitment. They have confused a good company with a good stock, and the market does not pay for good companies. It pays for stocks that are under accumulation, not distribution. This single day's price action is the final and most obvious act of distribution. And the novice has just volunteered to take the shares off the hands of the professionals at the highest possible price. Now let's look at the mechanics of this event through a more logical, dispassionate lens. Why does this reversal happen with such speed and finality? It's a question of supply and demand, the only law that matters. For weeks, the large operators, the smart money, have been engaged in a careful campaign of distribution. Imagine them as the owners of a massive warehouse full of goods. They cannot simply dump all their inventory on the market at once. Doing so would crash the price and ruin their profits. Instead, they sell in stages, feeding their supply into the market whenever there is a surge of public buying. They sell on good news. They sell on positive earnings reports. They sell on upgrades from analysts. Each wave of public enthusiasm is an opportunity for them to lighten their holdings. The push to a new all-time high is often the final act of this play. It is a carefully managed event designed to create maximum public excitement. This is the moment the media celebrates the stock, drawing in the last of the buyers, the final wave of weak hands. It is into this crescendo of buying that the large operators distribute their final, and often largest, block of shares. The reversal happens simply because the professional supply has finally exhausted the retail demand. There are no more buyers left at these elevated prices who can absorb the sheer volume of shares being sold. The price stalls, it turns, and it begins to fall under its own weight. The close below the previous day's low is the definitive proof. It shows that in a single 24-hour period, the sellers not only absorbed all the buying pressure that made a new high, but they were so powerful that they drove the price back past the entire trading range of the previous day. This is not profit-taking. This is a changing of the guard. So how do we visualize this on a chart without even seeing it? How do we build this picture in our mind's eye? First, imagine a long, steady staircase climbing from the bottom left to the top right. Each step up represents a day or a week of rising prices. The trend is clear, established, and obvious to everyone. Now focus on the last two steps at the very top of this staircase. Let's call them day 1 and day 2. Day 1 is a solid, confident step up. It has a low point and a high point, and it closes near its high. The sentiment is positive. Now comes day 2, the reversal day. The day begins, and the price immediately pushes higher, climbing above the high point of day 1. It reaches a new peak, the highest point on the entire staircase. This is the moment of maximum optimism. But then, the energy wanes. The price begins to slide back down. It falls past the opening price, then past the closing price of day 1. It continues to fall until it breaks below the low point of day 1. By the time the market closes, day 2 has not only failed to hold its new high, it has closed near its own low, and its range completely engulfs the prior day in a bearish embrace. Picture a powerful athlete taking a huge leap forward, only to stumble and fall backward, landing behind where they started their jump. That is the essence of the one-day reversal. It is the visible evidence of immense effort that resulted in catastrophic failure. The message is not subtle. It is a clear statement that the forces pushing the price up have been defeated. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original, timeless wisdom, presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding the mechanics is one thing. Acting on them requires a clear and disciplined plan. This is where we move from theory to practice. The action plan for a Livermore one-day reversal is precise and unforgiving, because the signal itself is a warning of imminent danger. Let's break it down into its core components: the setup, the trigger, and the protective stop. First, the setup. The one-day reversal does not occur in a vacuum. Its significance is directly proportional to the maturity and extension of the preceding trend. A reversal that happens after a stock has been climbing for 5 or 6 months in a near-vertical fashion is infinitely more powerful than one that appears after a mere 2-week advance. So, the setup requires you to identify a stock in a late-stage mature uptrend. You are looking for signs of fatigue. Perhaps the upward thrusts are becoming shorter. Perhaps the volume has been churning, meaning high volume with very little upward price progress, a sign of distribution. The news surrounding the stock is likely euphoric. The story is known to everyone. This is the fertile ground where tops are formed. You're not trying to predict the top. You are waiting for the market to show you its hand. Your job is to be an observer, not a prophet. You are looking for a leader, a stock that has been outperforming the general market, because it is often the leaders that top out first, as they are the ones with the largest institutional ownership and therefore the most stock to be distributed. Second, the trigger. The trigger is not a feeling or a news story. It is a specific, non-negotiable price event. Let's be crystal clear on the definition. A valid one-day reversal consists of 2 days. On the second day, the price must first trade at a new high for the current swing or trend. It must exceed the high of the previous day. Then, before the session concludes, it must reverse course and close below the low of that same previous day. The close is the most important price of the day. It is the final settlement between buyers and sellers, and it tells you who won the battle. In this case, a close below the prior day's low is an unambiguous victory for the sellers. It is critical to wait for the close. Attempting to act on this pattern midday is a fool's errand, as the price could easily recover and close strong, invalidating the signal. Patience is your shield. The trigger is the final closing price and nothing else. Third, and most importantly, is the protective stop. If you are already in a long position and you see this pattern form in your stock, the signal is to exit the position. This is not the time for hope. This is the time for capital preservation. The market has given you a gift, an early warning to get out before the real markdown phase begins. To hesitate is to invite a significant drawdown. For more advanced operators who might consider initiating a short position based on this signal, the stop-loss placement is equally logical. It should be placed just above the high of the reversal day itself. Why there? Because that high represents the point of maximum bullish conviction before the trend failed. If the price manages to rally back and exceed that high, your thesis is proven wrong. The reversal was a fake-out, a shakeout, and the trend remains intact. By placing your stop there, you are defining your risk precisely. You are telling the market, this is the point where my idea is invalid, and I will accept a small, manageable loss. Without this discipline, a speculative short trade can quickly turn into a financial catastrophe. Now, we must consider the nuances and variations because the market is not a perfect machine. It is a dynamic environment, and patterns can present with slight differences. What if a one-day reversal forms, but the volume on that day is unusually low? This is a point of caution. A genuine, institutionally driven reversal is almost always accompanied by a surge in volume. High volume is the footprint of the large operators. It confirms their activity. It shows that large blocks of stock changed hands. A low-volume reversal suggests a lack of conviction from the sellers. It might be a minor pause, a bit of indecision, rather than a true turning point. While it still warrants attention, it carries less weight than its high-volume counterpart. High volume is the fuel for major trend changes. Another scenario. What happens after the reversal day? The follow-through or lack thereof is crucial. If the day after the reversal shows immediate and aggressive selling with the price opening lower and closing on its low, it provides powerful confirmation that the trend has indeed changed. The sellers are pressing their advantage. Conversely, what if the next day the price just sits there, moving sideways in a narrow range? This indicates a temporary balance between the new wave of sellers and some residual buyers. The situation is still precarious, but the immediate pressure is off. The most dangerous scenario for a new short position is if the price on the following day rallies and closes back above the midpoint of the reversal bar. This is a sign that the buyers have not given up and are attempting to reclaim control. It is a warning that your stop-loss, placed above the high, may be tested. A professional trader respects these nuances. They understand that the initial signal is the beginning of a new story, not the end. They watch the subsequent price action to see if the story is being confirmed or denied by the market. It is also vital to consider the broader market context. A one-day reversal in a leading stock while the overall market index is also showing signs of weakness is a far more reliable signal. This is what Livermore called trading in harmony with the line of least resistance. If the entire market is starting to roll over, it creates a powerful tide that will pull even the strongest stocks down with it. A stock trying to fight a bearish general market is like trying to swim upstream against a strong current. Conversely, if a single stock has a one-day reversal but the rest of the market is roaring higher, the signal is less reliable. It could be an isolated event specific to that company. The highest probability trades occur when the general market, the industry group, and the individual stock are all aligned. This top-down analysis provides a powerful tailwind for your trade. Ignoring the context of the general market is one of the most common and costly mistakes a trader can make. Let's synthesize this. The one-day reversal is far more than just a two-bar pattern. It is a story about psychology, force, and the transfer of risk. It's a story of the public's euphoria being used as the exit liquidity for the professionals. It represents a tipping point where the upward momentum that seemed unstoppable finally hits a wall of supply so immense that it cannot be overcome. For the speculator, it is one of nature's most potent warning signs. It tells you that the character of the market has changed, often overnight. The easy money in the uptrend has been made. The path of least resistance is no longer up. It is now most likely down. To see this signal and to ignore it, to hold on to a long position based on hope or a belief in the company's fundamentals, is to argue with the market itself. And as history teaches us, the market is never wrong. Opinions often are. The price action, the tape, as Livermore called it, is the final arbiter of truth. This pattern is the market speaking that truth in the clearest possible terms. Our goal as traders is not to be right all the time. That is an impossibility. Our goal is to be profitable over the long run, and that is achieved primarily through rigorous risk management. Recognizing signals like the one-day reversal is a cornerstone of that practice. It allows you to step aside when danger is apparent, preserving your capital for a time when the odds are more clearly in your favor. The greatest skill in speculation is not aggressive buying, but patient waiting and disciplined defense. This pattern is your signal to raise your shield and defend your capital. It is the market's way of telling you that the season has changed, and it is time to seek shelter until a new, clearer trend emerges. This is not a game of prediction, but a game of reaction and adaptation to the ever-changing tides of supply and demand. The lessons from a simple pattern like this extend to a broader philosophy of market participation. It teaches us to be skeptical of euphoria. It teaches us that when the news is best, the risk is often highest. It forces us to pay attention to the market's actions rather than its words or the stories told about it. It is a masterclass in reading the subtle and sometimes not so subtle clues left behind by the large informed interests who truly move the market. Learning to identify this pattern and others like it is the beginning of learning to read the market's mind. It is a language, and with time and dedicated study, anyone can learn to become fluent. This is just one piece of a much larger puzzle. The market communicates through a rich and complex language of patterns, volume signatures, and structural behaviors. Each piece you learn adds another layer to your understanding, making the picture clearer. If you want to understand more of this language, to decode the messages that the market sends every single day, stay with us. The journey of mastery is long, but the rewards of true market understanding are immeasurable.